Welcome back to the channel. Today we are going to talk about a topic that generates enormous excitement in the financial world every time it happens, the IPO. You have probably heard this term many times on financial news channels and in conversations about the stock market. But what exactly is an IPO? How does it work? And should you invest in one? By the end of this video, you will have a complete and clear understanding of everything you need to know about IPOs. Let us get started. IPO stands for Initial Public Offering. It is the process through which a private company offers its shares to the general public for the very first time and gets listed on a stock exchange. Before an IPO, a company is privately owned. Its shares are held by the founders, early investors, venture capital firms, and private equity funds. The general public cannot buy or sell these shares. When a company decides to go public through an IPO, it is essentially inviting ordinary investors like you and me to become part owners of the company by buying its shares. After the IPO is complete, the company's shares are listed on a stock exchange like the NSE or BSE in India, where they can be freely bought and sold by anyone. Companies launch IPOs for several important reasons. The most common reason is to raise capital, fresh money that the company can use to fund its expansion plans, pay off debt, invest in new products or technology, or enter new markets. Going public through an IPO is one of the most efficient ways for a company to raise large amounts of money quickly. A second reason is to provide an exit opportunity for early investors. Venture capital firms and private equity funds that invested in the company at an early stage use the IPO as an opportunity to sell their shares and realize their returns. A third reason is brand visibility and credibility. A publicly listed company gets significantly more media coverage and public attention than a private one, which can help attract customers, talent, and business partners. And finally, being publicly listed gives a company a currency, its own shares, that it can use to acquire other companies or reward employees through stock options. In India, the IPO process is regulated by SEBI, the Securities and Exchange Board of India. Here is how it works in simple terms. First, the company appoints investment banks called book-running lead managers to manage the IPO process. These banks help the company determine the IPO price, prepare the necessary legal documents, and market the IPO to investors. The company then files a document called the Draft Red Herring Prospectus or DRHP with SEBI. This document contains detailed information about the company's business, financials, risks, and how it plans to use the money raised. After SEBI approves the IPO, the company announces a price band, a range within which investors can bid for shares. The IPO is then open for subscription for typically 3 days, during which retail investors, institutional investors, and high net worth individuals can apply for shares through their Demat accounts. After the subscription period ends, shares are allotted to successful applicants and the company gets listed on the stock exchange, usually within a week of allotment. This is the question everyone asks. Should you invest in an IPO? The honest answer is, it depends. Not all IPOs are good investments. Some companies list at a significant premium and continue to deliver strong returns for long-term investors. Others list at high valuations, disappoint on performance, and see the share prices fall significantly after listing. Here are some practical points to keep in mind. First, always read the DRHP carefully before applying. Understand the company's business, its financials, its growth prospects, and the risks involved. Second, check the valuation. Is the IPO priced reasonably compared to its peers in the same industry? An overpriced IPO is a poor investment regardless of how exciting the company sounds. Third, consider the purpose of the IPO. Is the company raising fresh capital for growth, which is positive, or is it mainly giving early investors an exit, which means the people who know the company best are selling their shares to you? Fourth, have realistic expectations. Not every IPO will give you listing day gains. Treat an IPO investment the same way you would treat any other stock investment, based on fundamentals and long-term potential. To summarize, an IPO is the process through which a private company offers its shares to the public for the first time and gets listed on a stock exchange. Companies launch IPOs to raise capital, provide exits for early investors, and gain public visibility. In India, IPOs are regulated by SEBI, and investors can apply through their Demat accounts during the subscription period. Not all IPOs are good investments. Always research the company thoroughly, check the valuation, and invest based on fundamentals rather than hype. If you found this video helpful, please like and subscribe for more content on stock markets and economics. Thank you for watching, and I will see you in the next one.